Hey guys, I'm excited to make this video. I've been fired up about this for a couple days now. Hopefully through this video you'll understand why I created the oil balance and why that's so important to me. Hopefully you'll understand how much insight you can gain from a properly done balance. Why it's so important that you need to know what the variables are that you've put in there and what the premises are you've built the whole thing on. Hey, I'm Aaron, with over 30 years of experience in oil trading and analytics, and I'm here to elevate your understanding of the oil market. Okay, so let's get into it. The EIA released their STEO report, Short Term Energy Outlook Report. They do it every month. It's like a big, overly complicated balance, but it serves as a tool, a starting place, something to go off of, a frame of reference, maybe. But this month, it seemed to be particularly bad. And some people out there, I've seen other YouTube videos, have just sort of picked it up and run with it. Like, that's just the way it is. We're not even going to think about it. That's just how it is. And they've come to some conclusions because that's what an oil balance is supposed to do. That's what it is supposed to help you make those sorts of decisions. But I think because the premise is wrong and they're not, the DOE or the EIA is not referencing back some of its own source material, that they're getting misguided. They're getting a little bit off guard. And they're leading people down the wrong track. So that's what I want to go over with you today. And so let's go ahead and start the presentation here. Just give me 1 second to figure out how to move that over. All right, here we go. So to start this week, like we do most weeks, we're going to go ahead and start with the price chart. So this week we actually did bounce off of that support line. There was this downward trending line you can see here that through the course of the week we actually broke back above. So I thought we were in a pretty good position to move below it, but obviously stuff going on with the Druzhba pipeline. Brent really took off this week and started to widen that TI Brent ARB again because of concerns over the Druzhba pipeline and how Hungary's going to get oil now. It seems like, again, hopefully that'll be a short-term deal that'll get patched up pretty quickly. But, you know, it's another bullish thing that just kind of randomly happens, right? So I think for now, the way this chart's shaping up for the next little bit, we're probably safe. We're probably going to hold this 61.80 line. But I'm telling you, in the next 6 to 8 weeks, once we get into refinery turnaround season, I think we need to retest this line and maybe see what's down here at 55. Not for very long, just kind of bounce down there and see what's there. I don't think we'll break below it. We'll see. Obviously, something could happen. Some news could come out or something. But for the time being, I think we just kind of bounce along here sideways until we get into turnaround season. So let's take that as our premise going forward here. But I want to get into a little bit more about what the EIA said in the latest STEO report. So just to kind of start things off, they said they're expecting builds of 2 million barrels per day in Q4 25 and Q1 26 due to OPEC Plus accelerating production increases. So if you've been watching this channel for any time at all, you already know that that initial premise is wrong. But let's just kind of keep going with that. So 2 million barrels per day for 6 months, 360 million barrels globally. They show you in there how big the US builds will be, and it's not terrible. If you accept this as the premise, the builds shown in the US I think is probably plausible. And then they go on to say that Brent crude will average $51 in 2026. And again, this is an average for the whole year. And that WTI would average $47.75 for the entire year. All right, so they're taking some pretty big step down. 58 was already probably too low from last month's update, but now they've taken that all the way down to 51 per Brent. Again, TI is going to be $3-4 below that, just sort of depending on what's going on what they are, but that's typically the range. Somewhere between $3-4 is usually where that spread lands. So again, if you just accept the initial premise that there's going to be 2 million barrel per day builds for 6 months, okay, maybe it sort of plays out that prices will get smacked down pretty good. Maybe they're being a little too aggressive, but again, it all kind of goes back to this initial premise. The next thing they said is that the forecast for production, they have at 13.41 for full year. Year to date on the weeklies, we're already at 13.44. So it could be the case that production sort of starts to grind lower as we go on through the year. Again, that's plausible. So I'm not too upset about the STEO forecast versus the weeklies so far. And of course, they have 2026 forecast. Again, this is a yearly average at 13.28 million barrels per day, down from 14.31. That's a huge decline. If you look at exit to exit, where they have December 2025 production going out versus December 2026, that's something around the lines of 450,000 barrels per day decrease in production. So that's a lot. So that's a lot of production to lose. But again, based on this premise, maybe it's not so crazy. They talk about gasoline prices down 20 cents per gallon year on year. Again, that may not be crazy either. There's some structural things going on that we should probably talk about, where maybe it goes down even more than that. Diesel inventory should remain low, according to them, which would keep margins strong. Again, the very low price environment for crude probably makes it easier for refiners to do their job, assuming that the margin is still there. So it sounds like what they're saying is that you'll have a good margin on diesel, but maybe a little bit of a worse margin on gasoline. And, net maybe cancels each other out and stays, somewhat average. We'll see based on these headline numbers that they put out. They think strong exports will continue. I've got some questions about that, some issues about that. And of course, we have some decreases in refining capacity coming in 2026 that will make things interesting, especially in California. The problem, of course, is that when you close a California refinery, that doesn't really impact the rest of the country too much. And in this channel, it's not that we're hating California, it's that we are looking at the futures contracts, and those are really hardly ever impacted by, those are East Coast or Oklahoma contracts and hardly ever impacted by things that go on in California. So that's sort of where we're starting with the premise, and some of the problems that I have already, I think will be made evident. So again, here is just lifted from their data set, the inventory builds that they're showing here. The dots are actual data that we have. The dashed areas are the forecasts that STEO is putting out, that short-term energy outlook. And they have this huge drop in price coming down, of course. Average price at $47.75 for the year 2026. That would shut down U.S. production. Just sort of full stop, just to kind of to get to the chase there. And I created this candlestick chart as well, sort of on an annual basis. So you'll see I took a lot of pains to make sure you could see the $70 line stick out pretty well, because again, keep in mind that is our Goldilocks number. At $70, producers are happy, and growing production, consumers are happy, still buying gasoline and diesel. That's the Goldilocks number. As we keep going down, production stops growing when you get to 60. When you get to, 50, you probably start shutting in production. You get much below 50, you're definitely shutting in production. You're laying off staff. You're looking for all sorts of ways to, innovate, to come up with new ways of doing things. That might take a little bit of time and a little bit more money, and you're already sort of crunched for money. Look, your midstream guys, they would be hurt by something like this quite a bit. It's possible you could have producers go out of business. Maybe some of the smaller guys just say, we can't do this. We can't grow anymore. Of course, most of the smaller guys that are getting bank loans anyway are hedged. But again, maybe the environment's just too difficult for them. The bigger guys would probably actually have a problem as well because they're not necessarily as hedged as they should be, whereas the smaller guys are actually sort of forced to based on the covenants they have with the banks to borrow money in the first place. So that being said, this forecast that they're putting out for 2026 is absolutely devastating to upstream and midstream. And again, it's not just midstream pipeline operators, it's also the export terminals, right? Because if you're reducing production by 450,000 barrels per day, DEIS versus DEIS, that's a lot of exports that are going to get cut in that time. So that's a lot of throughput. They usually get paid on the throughput of those terminals as the barrel moves to the water. That's where they get paid. So this particular forecast, the way that they have it displayed right now, would just be a disaster for a large part of our economy, especially here in Texas. And so, that's one of the places I want to start. If you've been watching our videos for very long, you know that there's a lot of contention about what's actually happening with the OPEC barrels. If you look at someone like Petrologistics, which I strongly recommend, again, if you're in the industry, please go talk to Petrologistics. They're tracking all the vessels, they're getting the pipeline data for all of these OPEC and OPEC plus countries, and they're figuring out where the barrels are going, what the volume is. They have ways of figuring out pretty roughly what the production's doing. And it's really good, really important data. And when you start looking at that data, you'll realize that at least versus January of 2025, the OPEC plus the 8 countries had already increased production by 2 million barrels per day by June versus that January number, right? So those barrels are already out there. Whereas the DOE or the EIA seem to be thinking, oh, that mountain is still coming. That that big tsunami of oil hasn't hit us yet. If you look at the data from Petrologistics, you realize that's already hit us. And if you look at their export numbers again from the 8 countries of OPEC, yeah, it's steadily sort of rising, but nowhere near the 400 plus a day that they've been advertising on the OPEC these OPEC meetings and these OPEC press conferences that they're putting out. So what's really going on? I mean, so we've been saying for a long time in terms of the OPEC barrels, one, they're just trying to justify overproduction from some of the countries. And two, they're trying to create some wiggle room for Saudi to actually increase their market share into Asia. And they can do both at the same time. And if you go back and actually read their press statements that they've put out, they do have a policy of trying to rein in some of the barrels that the overproducers have been, that they've been putting out too much of. They're supposed to be pulling back, while at the same time, they're raising the levels that Saudi is allowed to produce at. So it is sort of a both and situation in this case anyway. The second thing you sort of have to think to yourself is, why at this point in time would OPEC Plus want inventories to build for 6 months straight and drop prices, Brent into the low 50s and WTI into the high 40s? That doesn't make sense. So if you recall, in March of 2020, MBS in Saudi Arabia decided, oh, we're going to go after the speculators. We're going to crush U.S. shale. We're going to come out swinging. And sure enough, they ramped up production to 12 million barrels per day. So just as a little aside, they're sort of, I don't want to say struggling. Their goal is to get pretty darn close to 10 million barrels per day in September. We'll see if they can do that. And I don't mean from a technical point, can they actually bring those barrels out of the ground? I mean, can they find homes for those barrels? Can they actually reach 10 million barrels per day, finding homes in the Far East for that to be consumed? That's maybe a different question. But to get back to the story, in March of 2020, Saudi decided to go, scorched earth on U.S. shale, on the speculators, if you recall those comments coming out of Saudi Arabia. And of course, their timing was awful because, 3 weeks later, we went into lockdowns in the US and most of the world due to COVID-19 and that sort of thing. And demand just absolutely fell off the face of the earth. By October, we were going, we had that day where we had negative prices for WTI, which again is its own sort of debacle that happened, but it happened. And partly because the Saudis decided, well, we're just going to floor this thing and just put out all the crude that we can to crush shale. So could they do that again? Yeah, I suppose. But this time around, Saudi Aramco is a publicly traded company, and now they have investors. I don't think the investors, want Saudi Aramco to crush prices. So there's a little bit different dynamic. There is something that is the same though, and again, that's the idea that just to fund all their fiscal needs, just not just Saudi, but all sort of the Middle Eastern countries, you need $80, $90, $100 crude, depending on which country you're talking about. So for the EIA to come out and say full year Brent prices at $51, that's absolutely going to crush those economies in the Middle East, right? And if they were to let things go to the point where you're building 2 million barrels per day for 6 months, that's gone too far. And I'm sure they could get together at that point and really start to rein in production. Again, it might fall to Saudi again to do that, but now they're a publicly traded company, right? The Saudi Aramco is a publicly traded company. So again, going back to the balances and what STEO put out, it doesn't seem like there was that feedback loop in operation, right? Where someone said, well, wait a minute, the premise no longer makes sense because the logical outcome of the premise is $50 Brent or $47 WTI. And that means all the things we just went over. So there has to be, when you're creating these balances, there has to be some feedback loop. There has to be a point in time where you push back the chair and you look at the big picture and you go, is it, wait a minute, what are we really talking about here? Is this even feasible? The other thing, my other big complaint about this set of numbers is the weekly data, right? So if you look at this chart here on the bottom, this is sort of 2025 year-to-date weekly data versus the forecast. So again, I'm mostly focused on the transportation fuels, but I've also got crude in here just for, because that's such a big part of this discussion based on the balances that STEO put out. But so far we've got, we're down 137,000 barrels per day on gasoline, distillates down, even jet fuel's down a little bit. So if you look at it in terms of the historical pattern, where these solid blue lines are pretty much gospel truth. So this is sort of aged data now that they've been able to go back and to verify. And I think we can be really confident that these numbers are correct or very close to being correct. Obviously, 2025, we're still going through. 2026 is a forecasted number. I guess I'll get to that here in a second. But what I want to point out is for 2025, year to date, we are still, coming in at 14.26 million barrels per day versus 2024 at 14.37. So, fairly decent drop so far, full year 2024 versus year to date 2027. Again, these are average numbers, so we've only got really 4 months left to really try to make any improvements on these numbers. And there's obviously going to be some give and take. Gasoline's demand's probably going to continue to pull back a little bit. Diesel demand will probably increase because it's also used as heating oil in the Northeast. So if we get any sort of cold weather in the fourth quarter, you probably get a little bit of an increase there, just people topping off their home heating oil tanks ahead of the season. You get some demand like that we haven't seen for the past several months, right in the middle of the summer. So there is some, of course, some wiggle room on this year-to-date number, but let's contrast that really quickly with what they still have in STEO for 2025. So they've got 14.45 million barrels per day for that number. Now that seems just like a huge delta for us to try to cover the year-to-date numbers versus their full year numbers with only 4 months left. And yeah, I think you can argue that the gasoline numbers on the weeklies are probably too low and they've actually been coming in stronger on the monthlies. So let's maybe give a little bit there. And I'm trying to take renewable diesel out of the equation. That's why it says excludes renewable diesel, because that's another, I think, legitimate argument. But the way I structured these charts, both this page and the last page, is again looking at the sort of core refining sector. And yeah, there's some great refiners out there like Phillips who've done some absolutely fabulous work on renewable diesel, and they should, probably be rewarded for that. But most refiners aren't set up to run renewable diesel, right? They haven't set aside a hydrocracker to be able to do that. So that's why I sort of set it up this way, so you can, especially, it seems like a lot of my viewers are retail investors or short-term traders on the retail side. So I kind of want to start keying things towards your perspective and maybe looking at things that way. So anyway, that's why I've sort of structured it this way. But the point is, if the numbers are what they are, let's say that these STEO numbers actually prove true, and we do get this little bounce back. So we've got 14.45 in 23, and then it drops 800,000 barrels per day in 24, and then back up 800,000 barrels per day in 25, and then down 30,000 barrels per day in 26. If that's the way the numbers are, then fine. That's going to be choppy. That makes it difficult to trade. That makes it coming up with some sort of long-term play a little bit difficult to do, if that makes sense. But if they were maybe to take more time and be a little bit more introspective with their own data set, maybe they'd come up with numbers closer to this chart, where you actually start to see maybe something more important start to form. And that is, we had this recovery period after COVID, where things increased very quickly in 2021 in terms of demand. And then that rate of change obviously slowed down, 22 versus 21, and it slowed down again versus 23. And at this point, 23 is looking like sort of the apogee, the high water mark of the post-COVID area. And now, for various reasons, in 24, we've come back down. Again, this is, I think, widely agreed upon data we can take as gospel at this point. If the 2025 number comes in closer to what we have as year to date, then you start to get this idea of slowly declining demand numbers going forward. And I think there's some good reasons for that. And what I've done on this particular year to date versus 2026 is just taken the same delta, this 30,000 barrel per day delta that they have between 25 and 26, and applied it to the year to date numbers, right? And then come up with a 2026 number that's 30,000 barrels per day lower. Hopefully that all makes sense. But you can see, maybe if you take a little bit more care with the data, you can start to pull out more meaningful trends, like we're showing here, where perhaps demand did see an apogee in 23, and now we're starting to slowly grind down. Now, why would that be? And keep in mind, we're talking about gasoline, jet, and diesel. So there's a few really big things that happened. In 2024, you had the rise of renewable diesel. Now, I've clearly said right here, we've excluded that because that's sort of its own little market. There's its own set of equations in the refining end of that, if you want to call it refining. So it's got its own issues, and it's a drop-in replacement for diesel. So unlike biodiesel, you don't have to have any petroleum diesel to blend with. You could, it is possible you could drive your diesel truck up to a pump and say, do I want to put renewable diesel in, or do I want some sort of biodiesel blend? Right. And they're both going to work just fine. You're not going to have any problems. So 2024 was a huge year for biodiesel or for renewable diesel. I think something around 228,000 barrels per day of petroleum diesel was displaced by renewable diesel. This year it's been a little bit slower because of the margins. There's been some headwinds in the margins. It's somewhere closer to 140,000 barrels per day this year. So not quite half, but a little bit more than half of what we had in 2024. In theory, there should be 500,000 barrels per day of renewable diesel capacity sort of by the end of 25. So that could be a really big deal. And that could be a structural change as long as the government, as long as Congress is willing to keep the RINs as they are. And again, I'm not really hearing anything to the contrary, but they would need to keep the whole RINs program the way it is. The biodiesel blenders credit or in the new version of that, and those things in place. And then that keeps renewable diesel and biodiesel very, very competitive with petroleum-based diesel. The other thing you got to consider is we've removed, according to the White House numbers, 1.6 million illegal aliens from the system. And that's going to impact your gasoline demand. And that seems like a structural thing. So then the question becomes, is that just a, year-to-date 2025 kind of number? Is the government going to continue to do that? Can they keep that pace going? Probably not. Maybe it starts to dwindle down a little bit. But my point is structurally you have fewer drivers now in August of 2025 than you had in December of 2024 by a lot. I would say most of those 1.6 million people who are deported are probably driving. Do they all have cars? Probably not. Maybe some of them had multiple cars. I don't know. But I think that's a structural hit to gasoline demand that probably should keep going. So there are two easy headwinds that we can talk about to demand in terms of the refiners. Of course, as I mentioned, the renewable guys, so to maybe put it a different way, if you look at petroleum diesel plus renewable diesel, that number's actually growing slightly. That number's actually looking good. But again, I wanted to craft this presentation to be more about the generic refiner in the US and not the refiner like Phillips who has, a world-class renewable diesel setup in California, right? So make of that what you will. But again, mainly what I want to point out is if you set up your balances correctly, and if you're listening to what your internal data is saying. So what I mean is the EIA has this weekly data, and it seems like they're not paying attention to it because they're sticking with this demand number, and they're not putting in something closer to this demand number. The point being is if you start using the data available, and it's fine to start out the year with these sorts of forecasts. There's nothing wrong with that. The problem is that people run into is they forget to update them, or they forget to find that feedback. How are these assumptions doing? Did something change from the time that I made these first assumptions that causes me to have to go back and look at this again? So that's what I want to try to point out with this chart, or these two charts side by side, is that this seems much more compelling to me in terms of a long-term argument. If I was an equities trader and trying to set up my portfolio again for a longer period, meaning a couple years, this would be much more meaningful to me, right? To see this decline in demand and be able to actually have some arguments about it, or discussions about it. This up and down chop makes it much harder for me to start to lay out a plan of attack or plan of investment, whatever you want to call it. So hopefully you can see that by looking at the numbers, thinking about it, giving some feedback, double checking on things. Were my original assumptions correct? Do I need to go back and revisit those? You can start to elicit tools, or you can use this tool to elicit different trading strategies and things you might need to do. So the last thing I want to talk about here is maybe leave the STEO for just a minute and go to the Far East. So if you recall, for the last, I don't know, 2 or 3 years now, all the demand growth has been in the Far East, including India, China, right? And so a lot of that growth in demand is coming from the petrochemical side of things. So, you know, uh, ethane and PPG and, all sorts of stuff along those lines, and not necessarily gasoline, jet, and diesel, which is what I'm focusing on the presentation this week. But again, that there was sort of this understanding that if we could get India and China, with how many people they have in them, if we can really get those economies going and really start to build up a middle class who would then buy cars and need to build things. So you have the gasoline demand when they buy cars, needing to build new houses or whatever, industry or factories or whatever, takes a lot of diesel, right? So the idea is that's where your demand growth would come from. Petrochemicals does great. Those people turn around and buy cars. They buy, the construction in China is maybe something we don't want to get into right now. It's not been too pretty, but the underlying idea is that would sort of stimulate the overall economy, and then you'd start to see those things take off. The problem that we have here just this past week is there was a Bloomberg story from Sinopec, which is one of the big state-run refiners in China, warning that demand does not look good for them, especially in the second half of the month. So I've sort of this bottom chart's maybe a little bit more clear, where I've got the International Energy Agency now. So that's the IEA. Can get confusing. EIA is the US version. International Energy Agency is pretty good at putting out baseline supply and demand numbers. It's usually a good place to start if you're new to this sort of thing and new to building balances. It's not a bad place to start looking at their monthly oil market reports. Anyway, what I wanted to point out is this huge drop in gasoline and diesel that Sinopec is sort of flagging for the year. So what they said specifically was the second half of the year looks worse than the first half of the year. I went ahead and averaged out those numbers to give us a full year view. So sort of similar to the US, jet demand is actually doing pretty good. It's gasoline, and in this case, especially diesel fuel, according to Sinopec, that's really taking it on the chin in China. For 2026, the International Energy Agency is already saying that gasoline demand's going to continue to be bad in 26 versus 25. And then if you look at Sinopec versus 2025 versus 2026, all of a sudden that diesel demand shoots way back up in 2026. So that's interesting there. Here are the numbers that the IEA has put out, International Energy Agency again. And then here's the Sinopec number in the middle as to what they're looking for. So in other words, to go from this, assuming that the Sinopec is correct about this number in 2025, then to jump to what the IEA has for diesel in 2026 is this huge 200,000 barrel per day incremental jump. So again, that looks a little bit suspicious. Hopefully that works out. I'm not sure, but that looks a little bit suspicious. That sort of stands out like a sore thumb. There are inventories that you can get for the Singapore market. So if you recall, Singapore is just this little island. They have there's several islands, right? But and they have a bunch of refineries hanging out there. They've got a bunch of boats on floating storage, and they've got a lot of on land storage in and around the little island. So it's quite the hub for the Eastern oil market. Is kind of like the trading post, if you will, for that region. Typically you would sail to Singapore and then go to Korea or Japan or China, depending on, or coming the other directions, right? Depending on what you're trying to do. So inventories are increasing for light distillates, so that means naphthas and gasolines in the region. Counter seasonally, they should not be building like this, at this time of year. And then also for middle distillates, so your diesel fuel and jet, those are also increasing counter seasonally, bigger than what they should be doing for this time of year. So what is that doing to prices? So again, there is a little bit of apples and oranges here because we're dealing with all these different time zones. But over the course of the week, Singapore distillate is looking like the cheapest distillate on the planet, at least compared to these offerings that I have here for you to compare against. And Singapore gasoline is tied for the cheapest gasoline on the planet, at least compared to these offerings. What's significant about the gasoline is we're talking about Singapore 92 RON, which works out to like 87 octane. So it's a full octane, and the rest of these gasolines are BOB, so they're blend stocks, they're sub-octanes, right? So just right off the bat, if if they were in the same room, you would say, well, the Singapore barrel is worth more because it's got more octane in it, right? And then you have to go back and take in locations and all this kind of other stuff. But so it's a little bit surprising that Singapore is coming back as the weakest markets on the globe for gasoline and diesel fuel. That's not ideal. That's not what you want to see. Again, with the assumption that we've had for the last couple of years that Asia is where we're going to see all the growth or the potential for the growth in these different markets. So that's not ideal. The Singapore markets, recaps of the Singapore market, you're hearing about more and more barrels coming from China as they try to balance out their system internally, because they like to stay pretty much balanced on the refined product side of things. Margins sound like they were doing okay, but now we're starting to look heavy inside of China. And again, that's why they're trying to dump barrels into the export market to try to clear them out of the domestic market, to keep those margins looking good. There was another story too on Bloomberg I just want to run past you real quick, and it sounds like the state, the central government, wants to go in and look at older petrochem facilities and older refineries, meaning 20 years and older, and do some revamping or shutting down on those facilities. So what makes that interesting is a lot of the teapot refineries you hear are probably fit in that older than 20-year category. And that's fine if the state of China wants to do that. If that's the decision they make, that's the decision they make. It's their prerogative. But where it sort of bounces back on the rest of us is if those teapots are shut down, I mean, that's a lot. The barrels that you can't sell anywhere else usually end up going to the teapots in China. The barrels with all the cats and dogs, and you can't quite figure out how to fix it and where it should go. A lot of that ends up going to the teapot refineries at a really cheap price, and it gets run and turned into products. So that's going to make things interesting, especially on the fuel oil side of things. Well, there's also crude streams that for whatever reason that particular batch is off spec or whatever, and they find themselves going to a cheap pot refiner in China. So overall, if China does do the revamp, I think it makes things better and more streamlined, for them, but it definitely would make things more interesting for those barrels that are just a problem and you have to try to get rid of them. So here's sort of a recap of everything we went through. The Chinese optimization I just talked about. I think if you look at the STEO numbers just on the face of them and accept them for what they are, I think you would see upstream companies are at risk, especially deep water guys. And what I mean by that is it takes so long to develop those projects that if the market moves down to $47 for a full year, you're just going to shelve all of those deep water plans, right? If it's not already to FID and being built, those are just going back in the binder and back on the shelf, right? And you got to wait for a couple more years before prices start to turn around, and then you'll blow the dust off of them, and then you'll start the process again, and it takes 2 to 3 years to get those deep water things going. So, we're looking at a delay of 4 to 5 years, all things together, for any deep water projects that get canceled now, especially if they're in the early development stages of it. Like we said, midstream flows are at risk. I think both, maybe like my view or my take on the STEO report and the STEO report just at face value, midstreamers are probably in the crosshairs, especially those who are exposed to the export markets. I think refiners would benefit from the STEO transportation numbers again. So if 2025 is just a bad year and their 2026 STEO numbers are right, that year-on-year increase would obviously benefit refiners if that comes true. Again, I think my version of it, where you take the year-to-date numbers and for 25 and then subtract the 30,000 to get to 26, is probably a better way of looking at things. But again, we'll see how that plays out. Again, in sort of my view of things, I'm almost seeing this as a buying opportunity. So again, we talked about a price dip coming up here in the next 2 months or so. As we go into turnaround season, OPEC still needs to figure out how to constrain barrels, at least in the very front of the market. Again, it looks like Saudi is trying to slowly ramp up. They might need to pull those barrels right back off by the time we get to sort of October, November, December. But we'll see how that goes. And then Gulf Coast refiners, this is probably further on into 26, but after China does this optimization, Gulf Coast refiners could actually be advantaged by seeing more of those suboptimal fuel oil and crude blends. If we do start building barrels quickly, like the STEO forecast says, you're going to be trying to put stuff all over the place. Again, there's a lot of storage in the US versus other countries. China has a ton of storage. So between China and the US, those are going to be the places where these extra barrels go. So if you want to take that STEO premise of 2 million barrels per day builds, a lot of that's going to be, probably 90% of those builds would end up hitting US and China. Maybe a little bit goes to Europe. But it's just that US and China have the capacity to take those sort of barrels. So keep that in mind as things go forward. But again, be very careful just taking these things at face value. Sit back and think about them, maybe do some critical analysis of what they're saying. Find someone like me, an industry veteran, who can maybe help you walk through these things and maybe poke some holes in the numbers that they're putting out. You don't necessarily have to take them at face value. So hopefully this has been useful to you. If you like this sort of thing, please like and subscribe. And of course, go to our website, theoilbalance.com. There's a couple different ways to contact me there. There's a button where you can click for a trial subscription to our Elevate report. Again, the Elevate report's very detailed this week. I gave you sort of the quick cliff notes on this video, but the Elevate report goes through even more. So if you're interested in that, hit that little button that says add me to your distribution list to put me on a trial, and I will do just that for you. So hope you have a good day, and we'll talk to you later. Bye.